A capital gain or loss happens when you sell or otherwise dispose of property. The exam trick is that capital doesn't mean investment. It's about the type of asset and how you used it. Many things you own personally are still capital assets, but personal use rules can make gains taxable while losses are useless. That mismatch shows up constantly on EA questions. For most individuals, a capital asset is basically everything you own, unless a specific exception applies. Common capital assets include your home, your car, furniture, boats, collectibles, stocks, bonds, mutual funds, and cryptocurrency. On the EA exam, they love to test that personal items like a car are still capital assets, even though the loss rules are different. Here's the painful rule. Gains on personal use property are generally taxable, but losses on personal use property are not deductible. Sell your personal car for less than you paid? No deduction. Sell a collectible you held as a hobby for a profit? Taxable gain. The exam will often give you a personal use loss and see if you incorrectly try to deduct it. Holding period drives the rate. More than 1 year is long-term. 1 year or less is short-term. Short-term gains are taxed like ordinary income. Long-term gains may get preferential rates, and some assets like collectibles can have special rate rules. Also watch for tacking holding period situations, like certain gifts, where you add the donor's holding period to the recipient's. Reporting is another exam favorite. Capital transactions generally flow through Form 8949, then get summarized and netted on Schedule D. Even if you don't get an information form, like some crypto sales, you still report it. The form you receive doesn't control taxability. It just tells you what the IRS also knows. One more boundary line. Not everything that looks like a property sale is a capital asset sale. If you're the creator of certain property, like an author selling their own copyright, that can be non-capital in your hands and taxed as ordinary income, often reported on Form 4797. So always ask, what is the asset and what's the taxpayer's relationship to it? Avery buys 100 shares of Cedar Ridge Holdings stock and later sells them for a $500 loss. Almost immediately, she regrets the sale, so she repurchases the same number of shares of Cedar Ridge Holdings. How long must Avery wait after the sale to avoid the wash sale rules? The choices include 30 days, 365 days, 366 days, and 31 days. Think about it. The correct answer is 31 days. The wash sale rule disallows a loss if you buy substantially identical stock within 30 days after the sale and also within 30 days before the sale. Waiting 30 days is the tempting wrong answer, but day 30 is still inside the window. Day 31 puts you outside the 30-day post-sale period. Ethan and Sophia are married, but file separately. Ethan sells stock at a $4,000 long-term capital loss and has no other capital items. 15 days after Ethan sells, Sophia purchases shares of the same company's stock. How should Ethan report the stock sale on his separate return? The options include a wash sale with no current deduction or deducting some or all of the loss. Think about it. The correct answer is that Ethan has a wash sale and cannot deduct the loss currently. The wash sale rule applies when substantially identical stock is acquired within 30 days before or after the sale, and it includes acquisitions by the taxpayer's spouse. The tempting answer is deducting $1,500 or $3,000. But wash sale disallows the loss and instead defers it by adding it to the basis of the replacement shares.